One afternoon this summer, the stock market slipped. Not crashed, slipped. The S&P 500 lost less than 1%, the kind of day traders shrug at, but one number did not shrug. While the market slipped, Wall Street's fear gauge jumped 14%. The market moved like a bad Tuesday. The fear number moved like a fire alarm, almost 18 times harder than the index it watches. There is a number that measures fear itself. Most people have never heard of it, and in a single month, it went off 4 times, 4 parts. The gauge, the spike, the pattern, and the morning after, where this whole story flips. Let's go. So what is this thing? What kind of number panics 18 times harder than the market? It is called the VIX. Traders call it the fear gauge. And here is the twist. It does not measure prices. It measures insurance. Here is the plain English version. Investors can buy contracts that pay out if the market drops hard. Options: insurance for a portfolio. And like any insurance, protection has a price. When the crowd feels safe, protection is cheap. When the crowd gets nervous, everyone reaches for coverage at once and the price of protection climbs. The gauge reads that price, one number tracking what the crowd is paying right now to be protected. Watch it on a calm day. One green morning this summer, the index rose about 0.8%. Nothing dramatic. All 4 of the day's biggest movers finished up, and the fear gauge eased about 6%, drifting under 16. Cheap insurance, a relaxed crowd. That is the gauge asleep. Nobody pays up for protection when nobody expects a storm, which raises the real question. What does it look like when everyone wants coverage at the same time? That is the day the alarm went off. 60 points. That is all the S&P actually lost that afternoon. 60 points on an index sitting above 7,000. Not even 1%. Now watch the same day from underneath. All 4 of the session's biggest movers were the same kind of company. Chip stocks. Micron dropped more than 4%. Nvidia fell 3.5%. The chip group fell about 4%, and the Nasdaq, loaded with these names, lost almost 2%. The market's engine room was flooding, even though the headline number barely blinked, and the crowd saw it. That is what the gauge caught. Not the 60 points, the nerves underneath them. Traders watched where the selling was concentrated and started buying protection. Enough of it, fast enough, to push the price of insurance up 14% in one session. One afternoon, a slip on the surface, a stampede for umbrellas underneath. Here is the thing about an alarm that sensitive. You would hope it rings rarely. That month, it rang 4 times. 12%, 12.7, 13.4. Those are the next 3 alarms, and they all sounded within weeks of the first. Every time the index dropped close to 1% or more, the gauge did not slip politely. It exploded by double digits. A 1% decline? Fear jumped more than 12%. A drop of 1.2 on the day one giant stock cratered more than 14%. Fear leapt almost 13. And then the big one. The worst session in our whole archive. The Dow lost more than 1,100 points. The S&P fell 1.5%. And the gauge jumped again, 13.5%, closing past 20 for the only time in our archive. Now notice the asymmetry, because this is the mechanic that matters. Fear arrives in double digits. It usually leaves in single digits. On the month's best green days, the gauge only eased 8 or 9% at most, and a 0.5% slip barely moved it. That one nudged fear up just 6. But somewhere past a 1% drop, the gauge stops whispering and starts screaming. Insurance does not get slightly pricier in a storm. It gets repriced. So after that 4th alarm, fear sat at its highest close on our shelf, and the crowd was braced for the worst. What happened next is the reason this video exists. Fear at its most expensive. Protection at a premium. If the gauge were a forecast, the next session should have been a bloodbath. The next session was the strongest day in our entire archive. The S&P rose more than 1.5%. The Nasdaq soared more than 3%. Micron, the same stock that had been crushed the day before, down almost 10, rocketed more than 18%. Microsoft jumped 15.5%, and the fear gauge did not ease. It collapsed. down 17.5%, its biggest one-day drop on our shelf. No other day came within half of that. So was the gauge wrong? No, and this is the part almost everyone misses. The gauge never said prices will fall. It said the ride is about to get violent. It measures the expected size of the moves, not their direction. And the ride was violent. A 600-point Dow swing, a 3% NASDAQ day, an 18% stock. The turbulence the crowd paid to insure against did arrive. It just pointed up. Fear is a measure of motion, not a measure of doom. So let's close the loop we opened. That first afternoon, the market slipped less than 1%, and fear jumped 14%. Now you can read it. The gauge was not predicting a crash, it was repricing the ride. Bigger waves ahead, direction unknown. Every alarm that month said the same thing, and the morning after proved it cuts both ways. So here is your 10-second read. Two numbers, not one. The index and the gauge. If the index slips and the gauge barely moves, the crowd sees a bad day. If the index slips a little and the gauge explodes, the crowd is bracing for a rough ride in either direction. Next time a headline says investors are terrified, ask the better question. Terrified of what? The fall or just the speed? Next in this series, the day the market closed up a penny and 3 scoreboards gave 3 different answers. If this made the game make more sense, subscribe. The free letter at TrenchTom.com is the daily version of what you just watched. That's how the game works. TrenchTom out.